Wall Street just posted the strongest weekly rally of 2026, and retail investors are celebrating the US-Iran ceasefire talks like the war risk is over. But here is what nobody is telling you. While you were buying the dip, institutional money was quietly building the largest hedging position in 14 months. This is not a coincidence. This is the smart money playbook, and you are about to see exactly how they are positioning for what comes next. Let me show you the 3 macro signals that separate institutional winners from retail exit liquidity. Right now, oil prices are doing something they have not done since the 2020 COVID crash. Crude opened higher on ceasefire optimism, but the VIX oil volatility index is compressing at the fastest rate in 2 years. When geopolitical risk premiums collapse this quickly, it creates a dangerous feedback loop. Retail investors see falling oil prices as bullish for equities. Institutions see it as a liquidity warning sign. Here is why. Every major equity correction since 2008 was preceded by a 30-day oil equity decoupling event. We are now on day 23. The second macro fault line is earnings season stress testing. US banks and Netflix report this week, and Wall Street strategists are wrestling with a brutal question. How do you price corporate earnings when the geopolitical risk premium just evaporated overnight? The answer is you cannot, which is why institutional positioning is split down the middle. Goldman Sachs analysts are calling this the most uncertain earnings environment since the 2016 Brexit vote. That uncertainty is not priced into retail sentiment yet, but it is absolutely priced into institutional option flows. The third signal is the liquidity structure of this rally. Stocks extended their rebound on hopes for an end to the Iran war, but volume analysis tells a different story. This was a low-volume melt-up driven by short covering and momentum algorithms, not institutional accumulation. When rallies happen on declining volume during geopolitical uncertainty, they historically reverse within 18 trading days. We are now on day 12. So how are institutions actually playing this? 3 specific positioning strategies are dominating smart money flows right now. First, energy sector rotation. The United States Oil Fund ETF is seeing record institutional put buying despite oil prices rising. This is a classic volatility arbitrage setup. Institutions are betting that ceasefire-driven oil stability is temporary, and the next geopolitical shock will create explosive upside in energy volatility. Second, defensive equity hedging. The Invesco S&P 500 Low Volatility ETF just recorded its largest weekly inflow since March 2023. Smart money is not exiting equities. They are rotating into low beta names that outperform during volatility spikes. Third, precious metals accumulation. Gold and silver prices are at critical technical levels, and institutional buying is accelerating, despite the ceasefire narrative. Why? Because smart money knows that geopolitical de-escalation does not eliminate the underlying macro risks. It just delays them. Now let me take you back to 1991, because history is about to repeat itself. When the Gulf War ceasefire was announced in February 1991, the S&P 500 rallied 8% in 3 weeks. Retail investors piled in, convinced the war premium was gone forever. 6 months later, the market had given back all those gains and entered a grinding bear phase that lasted until 1992. The pattern was identical: low volume rally, institutional hedging, and a false sense of geopolitical security. The difference today is that we have real-time institutional flow data, and it is screaming caution. April 2026 is setting up to be the month that separates smart money from dumb money. The ceasefire talks are real, but the macro risks are not going anywhere. Earnings season will stress test corporate resilience. Oil volatility will reemerge the moment negotiations stall. And institutional money is already positioned for both scenarios. The question is, are you? This is not about predicting the future. This is about understanding how institutional capital moves before retail investors see it coming. The strongest rally of 2026 might also be the most dangerous, and the smart money playbook is already written. All content provided is for educational purposes only and does not constitute financial advice. Investment decisions carry risk, and you should consult a licensed financial advisor before taking any action.